Today, I am testing my skills by combining two popular indicators, EMA and MACD. My goal is to see if this combination can reduce incorrect moves in my trading. The Moving Average Convergence Divergence Indicator, also known as MACD, is a momentum indicator used to identify potential buy and sell signals by analyzing trends and tracking price momentum. But why combine it with the exponential moving average? After all, MACD itself is already derived from two EMA indicators. Am I essentially saying combine EMA with EMA and EMA? Well, let me explain the strategy. The exponential moving average is a trend following indicator that highlights the direction of a trend. By giving more weight to recent price movements, it is more responsive to market changes, making it ideal for short-term traders who need to act quickly. For higher time frames, we typically use a 200 period EMA moving average, while for shorter time frames often people rely on 100 period average, sometimes even shorter. However, if this period is too short, it can overlap with the information already provided by the MACD indicator, making it redundant. A price is considered to be in a bullish trend when it tracks above the EMA line. Let's look at a price chart. As you can see, when the price moves above the EMA, it's an uptrend, with the price pulling the EMA upwards. Conversely, a bearish trend occurs when the price tracks below the EMA line, indicating the price is lagging behind the overall trend for this security. Now let's move to step 2, which is the main act of our strategy today. It is the use of MACD crossover. Let's start with a quick recap. The MACD line compares short-term price momentum to long-term price momentum. The signal line on the MACD indicator is a 9-period moving average of the MACD line itself, acting as a smoother to reduce noise and provide clearer signals. The histogram is calculated as a difference between the MACD line and the signal line, visually highlighting the momentum strength and direction. And finally, the crossover, which is the key part of our strategy. When a bearish crossover happens above the zero line, it indicates that momentum is weakening after a strong uptrend. Therefore, we will only consider bearish crossovers when they occur above the zero line, as they suggest a potential reversal is an overbought condition. On the other hand, when we see a bullish crossover below the zero line, it indicates that momentum is recovering from an oversold condition. Hence, bullish crossovers are only significant to us when they occur below the zero line. That's it, just two simple steps and it makes up our strategy. Now let's quickly set it up on our trading screen. Click on the Indicators tab and add both the EMA and MACD indicators to your chart. For the EMA, adjust the length to a 100-period moving average, which is to align with our strategy. Then tweak the colors of both the indicators to make them more visually distinct and easier to track. Now the setup is complete and our screen is ready to use these indicators together. Now we'll go through a few examples to understand how to read this on the price charts. Here is the price chart for Apple stock over the past month. As our first check, we see that the price is tracking above the EMA line, which indicates it is in the bullish zone. This means we will only consider bullish crossovers on the MACD chart, and they must occur below the zero line. As you can see, the corresponding price movement on the chart confirms this setup, showing a clear upward movement as expected. Now let's move to another example. Tesla stock on a 5-minute chart. Here we can spot a bearish crossover on the MACD chart. This indicates potential bearish movement. However, the price is still in the bullish zone when we look at the EMA indicator, which means the price is above the EMA line. This does not meet our criteria as it goes against the trend. As you can see, instead of a significant drop, the price moves sideways as the MACD heads in the bearish direction. Now this has helped us avoid an incorrect decision we would have taken if we were only following the MACD indicator. Finally, let's quickly review another example from the same Tesla 5-minute chart. Just like the previous example, we see a bearish crossover on the MACD line while the price remains in the bullish zone that is above the EMA line. Again, this setup fails to produce a meaningful bearish move and the price continues moving sideways. Once again, our strategy has saved us from making an incorrect move if we would have just followed the MACD chart.